Let's get in our fundamental special guest for the day. He's just come back from a Europe tour and he's heard some very encouraging words about India. Joining us now to talk about that and his strategy for 2018 is Mahesh Nandurkar from CLSA. Mahesh, so good having you. Thanks so much for joining in. A bunch of things to talk about. We'll make references to your notes that you came out post the budget as well. But I want to start off with this Europe roadshow update. You met a clutch of investors, UK and Europe, and I believe what you thought was that most investors remain bullish on India.
Yeah, so basically what I would highlight is that, especially over the last 1 week or so, we have seen the volatility in the global markets and the potentially the US inflation scare, etc. But what I kind of came back with a feeling was that the fund managers are not too perturbed at this point in time on the global scenario as such. And given the fact that a lot of foreign investors have already reduced their India weighting over the last 12 to 18 months, about, now over the last 3 to 4 years, the India overweight has reduced from about 4 to 5 percentage points to now about, say, 100 to 150 basis points. So there's been a bit of a reduction in the India weighting. And our story that while the macro is looking adverse for India on various fronts, the micro and the corporate earnings growth is holding up better.
Hi Mahesh, good morning. This is Navneet. In fact, I was just coming to that point. I guess CLSA in its APAC ex-Japan portfolio, they've cut down India weightage by almost 3%. So what's the reason? Is it the valuation risk, or as you highlighted, the macro risk? There is an upside risk to inflation that everybody's been talking about.
No, absolutely. The macro story isn't really as attractive anymore. As compared to what it was, let's say, 12 months back. So 12 months back, India's macro story was picture perfect. Inflation coming down, rates getting cut, fiscal consolidation happening, current account deficit also at the lowest levels. But on multiple fronts, things have changed. So to that extent, from a macro standpoint, things are not looking as good in India today as it was 12 months back. I don't really see as a reason to panic as such. And what we have done, when you refer to our Asia Pacific portfolio strategy, is also that as compared to an 8 percentage point neutral weight, we were holding almost 24% in the Asia Pacific portfolio, which is almost like 3x. So there's been a bit of a reduction in that. So we still remain optimistic in our Asia Pacific portfolio. But yes, we have to take cognizance of the fact that macro in India has worsened.
Mahesh, just wondering, pre-budget, the whole conversation was centered around capital gains. And we've seen that come in, STT not go away as well. Now that you've had time to digest and speak to investors, what are they saying? Could this prove to be a stumbling block for India compared to some of the Asia Pacific markets?
It is definitely a small irritation for several international fund managers, especially on the operational side, because a lot of investors will be struggling with the calculation of things like NAV. How do you calculate NAV? Do you build in capital gains taxation, or you do not build in? So those kind of issues also come in. Also, given the fact that index, whether it is MSCI India or Nifty, those indexes will be calculated without any tax cost. So it will also become that much more difficult for fund managers to outperform the index, because there is a systemic sort of level drawback brought in by the taxation. But apart from that, I don't see this as a big investment decision hurdle as such. It's still a relatively small taxation as such. But yes, it is, I would say, more an operational issue at this point in time than an investment decision as such.
Did the conversation about this move by SEBI to not allow Indian exchanges to share data with SGX, and effectively at some point of time, if not 6 months, then 18 months, and the timelines out there are debatable, at some point of time SGX Nifty futures or the Dubai futures ceasing to exist. Did that come up in conversation at all?
Yes, that was a part of the discussion, especially because the SGX was also looking at introducing single stock futures on the SGX. So there was this possibility that some of the stock specific trading that happens on Indian bourses could have also shifted offshore. So some of the investors who do not have the FII registration in India at this point in time, or are concerned with the taxation issues, were looking at these other options. But now with those options being taken off, I guess the investors will have to be in India to be trading the Indian single stocks.
In fact, Neeraj, there were some reports indicating that now those FIs will actually move base to countries like France as well as Netherlands, where India has signed a treaty. Mahesh, my next question, I'm just going back to your roadshow in Europe, where HNIs, they actually remain bullish when it comes to the Indian markets, but still, what's the kind of India story that you sold to them, and what were the key concerns that they highlighted about India to you?
Well, so we have been very, very bullish on the whole housing recovery as the story. We believe that the housing affordability is at the best levels that we have seen in the last 2 decades. And that has been achieved because of the property prices remaining more or less flat over the period of last 3 to 5 years. But the incomes have grown at the rate of 8 to 10%. The mortgage rates have come down. So the affordability is really attractive, and we just need some form of a trigger for the housing market to start recovering. And I think we are probably, just about to witness that, especially now we have RERA in place and the buyer confidence has also been boosted because of that. So that has been the key pillar of us being positive on the economic growth outlook and the corporate earnings growth going forward. So that, I would say, is the big story. The second positive story is also the improvement in the corporate earnings growth in general. Over the last 3 to 4 years, the Nifty EPS growth has been in the single digits. Going forward, we expect that number to be in the range of 15 to 20%, especially for FY19. And we've already started to see some of that being visible in the FY18 numbers as well, in the sense that earlier we would always see massive earnings revisions on the downside after every result season. We have not really been seeing that over the last couple of result season. There are obviously some stocks where the earnings are getting revised downwards, and there are some which are getting upwards. But by and large, at the market level, it's been pretty much steady. So to that extent, the bottom-up story has also improved. So those were really the 2 key reasons.
Interesting. Mahesh, you of course wrote a fairly extensive note on the food inflation risk as well. I think in the first week of February. The rural recovery theme is probably something that you guys at CLSA are fairly bullish about. What are your own individual thoughts, and how would the rural recovery play out from a market's perspective? Would it be the standard consumption stroke rural beneficiary themes that will play out?
Yes, so we have been quite optimistic that the government's initiatives to prop up the rural consumption growth will yield positive returns. We've talked about food inflation going up as, a negative from the macro standpoint, but a positive from the rural demand perspective. I believe the ways to play that, would definitely be some of the names in the auto side, the tractor companies, some very, very select staple names. I mean, staples as a sector, we are underweight because we believe that the equation between the high multiples and the relatively lower earnings growth of 15 to maybe 18% or so doesn't really fit in well. But there are some select staples names that, we would also, look at as a way to play this. And there is also, an overlap between the housing, market and the rural markets as well, especially the rural housing stories or maybe the semi-urban housing stories. So that includes some of the, the low-ticket housing finance companies, or that would include, some of the building material names, not just cement, but also on the pipes side. So I think those would be the way to play actually both the housing story as well as the rural consumption story as well.
Mahesh, we can't let you go without taking your view on the PSU banking space. And if I'm not wrong, in terms of sector weightage, the maximum weightage that you guys have is on the financial side, considering whatever is happening with regard to the PNB fraud that has unearthed in the last 2 or 3 sessions. How are you guys approaching this space?
So, we continue to stay optimistic, on the financials, and that's obviously the largest sector from the market standpoint as well. But our preference is clearly for the private sector financials. So while we have been highlighting that the story of NPLs peaking out, and that would actually helping the corporate oriented banks, both on the private and on the public side as well. But we have always stuck with the top tier public sector banks. So to that extent, we still remain comfortable with the top tier PSU bank, but our preference is clearly on the private side because of two things. One is the recent banking sector developments that we've seen, but also aside from that, RBI has also tightened the NPL recognition norms. So that might also spring some negative surprises. So I would say better to stay safe at this point in time and still go with the private banks, even on the corporate banking side.
Yeah, even on the corporate banking side. Mahesh, always a pleasure having you, more so today. Thank you so much for taking the time out and speaking with us at Bloomberg Quint.